Hi everyone, thanks for joining me. I'm Richard Taken, CEO of Bathurst Resources for the quarter three FY16 update. I hope everyone can see that screen. So standard disclaimers. So look, anyone that doesn't know Bathurst, and I realise probably a lot of you are existing shareholders or know something about the company, but in case you don't, we are an operating company. All of our operations are in New Zealand. We've got Takatimu in the deep south, which is 100% owned by Bathurst. We've got Stockton on the west coast of the South Island, and we've got Rotowaro Mamaroa, which are operations in the North Island. So Stockton, Rotowaro, Mamaroa are owned through a joint venture. We own 65% of that with a New Zealand-based family company through an entity called BT Mining. So we'll look at those operations. We've been in that joint venture since 2017, and we've also got though a number of growth projects that again we'll cover in today's presentation. The Buller project, which is associated with the Stockton infrastructure, and will supplement the Stockton mine going ahead for another 20 years. The Tanas project, which is a greenfield project in middle BC on the west coast, and Crown Mountain, which we own 23% of with Jamison Resources, which again is in British Columbia. So they're our development growth projects, all in coking coal. So look, no real change to the board structure. Peter Westhouse is still our chairman. Russell, myself, executive directors, and Francois Tumahai, non-executive director. Russell's been quite a lot of time in Vancouver and up on the project site up at Smithers, which is about 11 hours drive north of Vancouver, as we move further forward into that final stages of the permitting for that project. Unfortunately, our share price has taken a bit of a hit lately. We're down below 60 cents, which puts our market cap at around 142 at the end of March. We had 117 Aussie million consolidated cash between the joint venture and our own books, giving us an enterprise value of 25 million. So, the implication there, we've got no debt apart from some yellow good finance of a pretty minor nature with a Takatimu mine. So, the company's been built around stable operations. So we generate cash. We've got a good mix of customers across the New Zealand base. So we've got coal going into process heat with major customers. We've also got coal going into steel making and electricity generation. So, that pretty much that group's been together since 2016-17, and we will show in a graph in a minute how we've been profitable through all those years. And then associated with each of those projects and also with our Canadian assets, we've got some growth projects, which again, the intention here is to build in a portfolio of assets that are generating cash, so then we can then start returning cash back to our shareholders. And the director focus at the present time, though, is very much on growth, and I'll sort of cover that in the next slide. So we have paid dividend and we have done share buybacks in the past. And as we know with the joint venture, we haven't got an automatic right of getting cash flowed out of the joint venture. But at the present time, we actually want that cash to be maintained within those various businesses, including Bathurst, to bring forward these growth projects. And that's really been our focus over the last 2 years. So, in New Zealand, we've got the Buller project. We've been investing with BT in the development of that, the overall project. And obviously, the key thing there is to bring forward a project that can go into the fast track in the near future and then come out of that towards the end of this year, early next year, with all of the project approvals that are going to be required. So, the growth capex at the present time has been really on that near-term and potential long-term coal projects, because we've been investing money as well with our joint venture partners on a equity basis into Crown Mountain, and then recently, or since 2022, into the Tanas project, which again is a very exciting development for Bathurst in that we get full control of those cash flows. And the same with the Buller project, we get full control of those cash flows. So we've got a strong balance sheet, as I said, no debt. We actively manage some of our forward sales. We've got hedging in place really to try and lock in super profits because we haven't got debt. We're not trying to protect on the downside, but we are trying to lock in whenever we see, like the situation now with the forward curve going over 250 odd dollars US in 12 months out. We're trying to lock in tonnage for our sales out of Stockton. So across New Zealand, I've already said, we've got those 4 operating mines scattered across from the length and breadth of New Zealand. Rotowaro and Maramarua principally supply steelmaking, a little bit of coal going into the last remaining thermal power station as well. Down the bottom of that, Takatimu, all of that coal goes into process heat, which is value add to New Zealand prime production. And then Stockton, 100% of that gets exported into customer base in India, Japan, South Korea, and a little bit into China. So, we've got a long established markets. Some of these customers have been customers of Stockton for 50 years. We've been into the Indian market for well over 20 years, and we've got some business development stuff into South Korea that's only in the last couple of years. So, we are still maintaining that customer base, even though we only maintain about 1.2 million tons of export. And then the Buller project is there to really take that Stockton infrastructure and then set it up for the next 15 years past the mine life of Stockton. So over the last quarter, we're a little bit down on where we were in the subsequent quarter last year, mainly around coal price, but also around some of our movements now in the domestic market. We've seen customers moving out of the process heat market in the South Island, moving to alternative energy suppliers and or getting out of the business. So that's been a reasonable impact on our 100% owned Takatimu business, but also on our North Island domestic business as well. EBITDA is down a little bit again. We have had a lower coal price in the first part of the year, which has now really bounced back to being a very consistent number. We're sitting at around about 230 US dollars per ton for our export coal. We get about 80% of that on an average across our full portfolio of sales. We're down a little bit on cash. Again, we've been investing heavily in the Buller project and in Tenas, but we've still got healthy cash reserves, around 141 New Zealand at the end of March. And we are at the moment sitting at a slight loss position, probably pull back to being even by the end of the year. But in terms of EBITDA, we believe we're well and truly on target. We've had a number of low-level incidents across the sites over the last quarter, which is really disappointing. It's caused us to go back and review, particularly our field leadership program, and try and address some of our behavioural safety aspects that have come out of those investigations and those incidents. We have been working extensively on our training management systems, and we're now moving into the next part of that, which is e-learning. So it actually frees up some time for people to actually be more one-to-one on some of the higher risk stuff, which is then rolling into our critical risk program, which has been ongoing, but has also been reviewed in light of some of these recent incidents to make sure that we are picking up the key critical risks here to make sure we're not going to end up with fatalities or multiple fatalities, as well as the risk of these minor injuries. So looking ahead, obviously we've only got a month or so left to go now. We've had an increase in the export stuff, particularly over the last quarter, where we've seen consistent pricing, and also some of our shipments have been in the high grade. Our North Island operations are up a little bit, but our South Island operations are down a little bit, including corporate costs. And again, a lot of that's to do with the shifting of the market. And also, we did have only really this year remaining in our Takatimu mine. We managed to extend that for another 2 years while we complete the rehabilitation as well. But it has meant that we're down a little bit this year. So we will see. Next year, we weren't going to be having any cash flow at all from that business, but we will still have a couple of $1 million flowing into the coffers. And obviously, Telqua, we're now moving into the sort of more pointy end of the permitting and environmental assessment work. So we are expending more money there than what we had anticipated. But we are still going to come in, we believe, well and truly on the top end of the guidance. And I think it's worthwhile reflecting when we formed the joint venture and we basically recapitalized Bathurst back in FY17-18. We took over the assets of the ex-Solar Energy, and we've made money every year. We're very dependent. Obviously, our export business is a large part of our earnings, and we're very dependent on the international coal prices, you can see from the red line bouncing around. and our EBITDA numbers bouncing around that. So this is the lowest numbers we're going to have for the domestic business, but we are in a growth phase. So uh, we've done the M1 development, which we're now starting to mine coal out with Marlborough Mine. We've done the Waipuna West cutback, which we're now starting to mine coal over the next 3 to 4 years out of there to supply into the market. So, we will see a return on that investment over the last 2 years, over the next couple of years. International coal price, the forward curve is reasonably healthy, and I think the key thing here is how flat it's been. We haven't seen, even though we've had the impact of obviously the US-Iran war. We've seen some high pricing, in particular in terms of diesel costs and things like that, and that's spread into some of the economic development around the world. But we are seeing still strong um, requests for coal out of India in particular, and that has really kept the market relatively flat. So it is in contango. We're seeing projections out 12 months out to 257 at the present time, and then the forward curve going out further past that is around that 250 mark as well. So we'll be reviewing that obviously solidly now because we're moving into a budgeting phase. We'll be setting up for our next year's budget. So after when we come back for quarter 4, we will give you an indication of where we see the guidance being past that point. So as I said, a lot of this we've been investing over the last 2 years in particular is around these extension projects and the growth projects. So, we really haven't had excess cash to be able to look at going into buybacks, even though, with a 60 cents share price at the present time, it would be nice to have that cash into that. But I think it's more important at the present time that we invest in these growth projects because as we see from that forward curve, there is still a lot of buoyant and positive attitude around coking coal. There's limited supply and there is still really no alternatives to coking coal and steelmaking. So that's where we are concentrating our business at the present time on these growth projects, but also on these extension projects within New Zealand. Bullet projects will be known to everyone. It's basically taking the existing infrastructure that's embedded within Stockton, taking the remaining coal that will be mined within the Stockton coal mining license and mining permit areas, but then adding to those with the Mount Fred South and then ultimately the Denison Plateau area. So each of these areas have got similar coal qualities, they're similar seams, but they've got peculiarities that then allow us to actually maintain the existing blends and the existing market going forward by about another 20 years. So we've identified about 19 million tonnes in the Buller Coal project. That's a combination of the remaining coal in Stockton, Mount Fred South, and the escarpment extension or the Denison part of that. And it's relatively high cost coal. We are going into deeper reserves and reserves that have been partly mined by underground mining. But if we look at the forward curve, we are still going to be profitable at today's levels. So it has got a good solid NPV, and it's got a relatively low startup capex, around about 105 million. I suppose the benefit for the Bathurst shareholders is as the Stockton tonnage, which is depicted in orange on this graph, drops down, it's replaced by 100% owned coal coming in from particularly escarpment and then from Mount Fred South. So Mount Fred South is 60-40, so it's 60% owned by Bathurst in terms of the amount of coal that's in it and 40% owned by the joint venture. It'll be a smaller mining area, whereas Denniston escarpment will be a larger mining area. And obviously one of the key pieces of infrastructure here for us is a haul road that joins the Denniston area to the south, which is the Buller resource, up into the infrastructure which is contained within the Stockton. So that's where the CHPP, the processing plant, and then the aerial conveyor going down to the rail loadout, which allows us to get that coal to market. So we're looking and we're working very hard at the present time on getting this fast track application submitted. Now we've had a number of dates on this. I do realise that. But what we're seeing with some of the applications that are either sitting with the panels and or have been through the panels is that it's all about front end loading. So the more work we do up front, the more consultation we do, the more agreement we get with the various stakeholders. And for us, the key stakeholders here are the landholder, which is Department of Conservation, Regional Council, which controls water and air discharges, District Council, which controls land use and is really the proxy for a lot of the community concerns. So, we've been working hard with all of those groups in particular, but also local landholders, our local communities, which are, very dependent on the jobs that the Buller mine at the present time, Stockton, provides to that area. We employ about 350 people directly, and without the mine, the town is going to suffer. So, that has been our focus. Obviously, this is a project that is quite large, particularly on our scale, but also on New Zealand scale. 20 million tons may not be a lot in the middle of Queensland, but it's 20 years worth of production for us. So, it has a large impact on the local area. At the present time, we're injecting somewhere around about $40 million a year just in wages alone into the local area. Plus, then you've got all the soils and services that come from it. So it's an important part of the local and regional economy. And that's really where the fast track comes into it. It allows us to then put that application in. Again, the more we've got agreed up front, the quicker we'll go through that process and the more certainty we'll have. And that's where we're working on now. So that's why this time frame's been slipping. As issues have come up, we've tried to deal with them up front with the people that are actually going to be the decision makers so there's no surprises. We're still aiming for that to be in this quarter 4, and then we'll be out of that process by the end of the quarter 4 next year. And really, it just depends on how it's viewed by the panel, and also what the assessment timeframes that we are given. So the more we can get agreed and the more we can get negotiated up front, then obviously that'll pull back those timeframes. With the Tenas project, really similar sort of timelines, different process. So in British Columbia, there's an office called the Environmental Assessment Office, which basically handles the environmental management part of it. And then there's a mines department, which handles the permitting, which then gives you the final permit to actually go forth and start doing all of the works you need to do and the mining process post that point. So we're looking to submit within the same sort of time frame, so into June for the environmental assessment. That takes about 6 months. And then we'll then start in with the permitting phase, which takes around about 12 months. So again, this is a smaller project on world scale, both in terms of the output, but also in terms of the amount of capital that's going to be required. So that, it's a relatively compact mine site. There is other resources within the area, but we're concentrating at the moment on the Tenas block. And again, it's quite a low strip ratio. We're looking at around about 4-to-1 over the whole block. Relatively simple logistics. We form a haul road across to a block of land we own, which then gives us access to rail. And that rail is the closest rail to coal port of Ridley, which allows us then to market the coal into the national market. Again, some of the specs you would have already been familiar with, but a similar sort of time frame. We're looking at about 22 million tons of production, 20 odd years of mine life, around 140 million set up on capital. It'll be a low cost operation because of the strip ratio mainly, and relatively simple mining methods and good recoveries through the wash plant. We're looking at 70% plus recovery through the wash plant as well. So the cost per product ton will be around about $80 US delivered to Prince Rupert or the Ridley port. Good MPV, 270 million US post tax, with a good internal rate of return as well. So again, we've permitting is the key here. We've got to get the environmental assessment application in, and then while we're doing that, we'll also be submitting the permit docs. And as I said, the permitting takes around about 12 months on average by the time you get the permit docs in front of the regulator and then out of that process. And we have been, we've released the results of the DFS, which is some of the key results we just had on the last page. But we've also now started to look at some of the forward works for the access road and the civils and getting into mining. So we are looking to try and bring forward some of the drilling work, particularly around the geotech work, going forward into the next phase, which then gives us a bit of a piggyback towards first coal in around FY29. So it's looking at Bathurst, how we sit today. We've got, in terms of New Zealand dollars, 141 million consolidated cash, zero debt. We're going to earn somewhere around about 45 million EBITDA for this year. We've got a net asset backing in the New Zealand dollar terms, again, of $1.50. And if we look at Australian terms, in terms of where our share price is sitting now, we've got a cash backing of 49 cents, but we've got an asset backing of $1.24 as we stand at the moment. And as you can see from the last couple of slides, we've got a long tail of production sitting there that'll take us through to about 2.5 million tons a year. And that doesn't include the option that we've got with Crown Mountain, which is still a very good option. We own 20% of that project. It's costing us a small amount of money each year at the moment to maintain that option. But, that's a billion-dollar project looking at the forward curve pricing of around 250. So, it is a great option for us going forward. It's a little bit further down in the development timeline than the other two projects. That's why we're not concentrating that in terms of these immediate sort of announcements, but it is still a good option for Bathurst. So, just to try and sort of pull that together, we've got profitable operations in New Zealand, both across the joint venture and our Takatoom 100% owned. We've got good cash reserves that will be applied to these projects. We've got the fast track application nearly complete to go in, and that'll give us all the approvals that we need to then get going. And that's the big difference that the fast track brought us back in December of 24, was that ability to put one application in and then get all the approvals that we need, rather than death by a thousand cuts through every other regulator in the country. Again, we've backed that project up with a pre-feasibility study, and we're working on the DFS now. We've got good backing from the New Zealand government, both in terms of the fast track acts being passed under this present government, but also metallurgical coal's gone into the critical minerals list. So, that gives us the basis that we need to then go out and seek further assistance from government, particularly around trying to bring on strategic minerals. And the Tenas project again is backed by confirmation of reserves earlier this year, of financial year, I mean, and with the DFS results backing the investment. So why invest in Bathurst? We're increased our weighting of sales into steel making. It's well and truly above 90% now. We've got a good portfolio of assets with British Columbia. British Columbia's had a big turnaround in terms of where their attitude has been towards mining. They see it like New Zealand and a lot of other countries. Australia has always seen this benefit that you either mine it or you grow it, and there's big benefits in utilizing your resources properly. And nothing that we're talking about with the fast track is going to take away from any of our environmental management, any of our people management for that matter as well. So these aren't going to end up with disastrous projects because they've been through a fast track process. They're going to end up with a better project because it's had more consultation, and it's going to come out and be a project that's actually more deliverable than if it went through the standard process. We've got global recognition of metallurgical coal being a critical mineral, both in terms of Europe, US, and New Zealand. We've got a history of generating profits, as we've seen from one of those earlier graphs, and also maintaining a guidance. We have always been conservative, I suppose, but we've also met our guidance over the years. We've got a good balance sheet, no debt. We've got a strong cash position, which we will be applying to these various projects within the joint venture and outside of the joint venture. And, we've got really near-term potential for these longer life projects, all in metallurgical coal in New Zealand and Canada. And we've seen the market reacting positively to even things like the US-Iran war, where it's just indicative of the fact that there's no further large chunks of supply coming to the market. but there's still a real use for that coal in steelmaking. So we believe that's the thematic that a lot of people are investing in Bathurst and other metallurgical coal companies. And pretty much our total focus now is steelmaking. So look, thanks for your attendance, and as usual, if there's any questions, there's a link in the presentation that allows you to send them through, and we'll endeavour to get back to the next couple of days. Thanks very much for your time. Look forward to catching up soon. Thanks.